Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. The US Federal Reserve missed its opportunity to hike interest rates for the first time in almost a decade. The Australian share market is in the unique position of being the first global market to get a full market reaction in Friday's trading. With this in mind, I caught up with Brun at OptionsXpress to get his verdict on the US Fed's decision and also market moves moving forward. Brun, welcome to Dukascopy TV once again. It's a pleasure to see you and catch up.
Nice to see you, Natalie.
So you must have been pretty disappointed when we didn't see that rate hike from the Federal Reserve this morning. In some of the comments in the announcement, it was quite ironic really and quite unusual even that the Federal Reserve did comment on concerns regarding global market issues and particularly name-dropping China. Given that one of the biggest market uncertainties that we've had in recent weeks is whether or not the Federal Reserve would hike those rates, is this not a little bit the pot calling the kettle black?
It possibly is. However, I mean, the concerns, I mean, first and foremost, I was a little bit disappointed because I was saying September, no two ways about that. And to a large degree, I think that, you know, they might have missed an opportunity because there's always going to be reasons and excuses now. Global market volatility, yeah, we could say, well, a lot of the volatility that we're seeing and the uncertainty is because you guys just won't give us a clear indication of when you're going to hike rates. Just get it out of the way, please. So, I mean, that was to a large degree, what, you know, in terms of what we've seen. But, you know, for all those that have been bemoaning the volatile nature of commodities, currencies, equities, unfortunately, with the Fed giving us no real clear indication of what's going on, we're just setting ourselves up for another month of volatility. That goes across all those asset classes that I said. So, you know, I really, if the first rate hike is purely symbolic, it doesn't really mean anything. It's not because the US economy is going absolutely gangbusters. It's going well, but it's not going gangbusters. What are you waiting for if it's just symbolic? If it's just no longer required at emergency settings, and that's basically all the first one or two rate rises are going to be. We don't need emergency settings anymore. I don't understand why you would wait from September to October to December. I mean, it makes no difference at all. Okay, you know, I'm not a central banker. I don't understand, you know, all the you know, to the nth degree, all the pieces of data, but, you know, just from the outsider looking in, just get it out of the way. Remove that cloud of uncertainty. I mean, that's what, you know, certainly market participants that I speak to would really like to see. We know, especially equity prices, it's a forward-looking indicator. If they can't look forward into the future or there's a big cloud of uncertainty, why are they going to trade? And that's why we've been whipsawing around, unfortunately.
Well, this is the thing. We know in the longer term that US interest rates are going to rise. That's a given. It's just when that process will start, I guess. But also, I mean, with that said, you know, we've moved back to a clearly data-driven Fed with those comments regarding sluggish inflation. How does this change the timeline? Are we simply looking at October, or should markets even be preparing for that early 2016, as some policymakers did indicate?
You know, there's always going to be a reason. There's always going to be an excuse, whether you're cutting or whether you're hiking. There's always a reason not to go. So that just makes me think, just go. Just, you know, you're going to do it. Get it out of the way. And 0.25, if they were to hike by 0.25%, I mean, the difference between, where is it now, 0.12, or, I mean, it's just zero, but let's call it zero, and 0.25%, there is going to be no difference really to the real economy. It's going to take so long to find out what effect that's going to have anyway. We're talking 6, probably 12 months. So again, I come back to, come on, guys, just can we get this out of the way, please? And you're right. I mean, they have said it's coming. And as I said, it's a symbolic rate rise that you know, the meaning. I know inflation's a key piece of the puzzle that's clearly missing, and global affairs. I mean, there's nothing to my mind that thinks, you know, certainly emerging markets, China, even Europe, which has calmed down a little bit. I mean, it's still going to be, there's still going to be a degree of uncertainty, and the Chinese economic data is not, you know, there's nothing there to suggest it's going to all of a sudden, you know, start peaking again. I mean, it's still sort of bottoming out, and the PBOC at least does have triggers at their disposal. They've got ammunition and firepower that no other central bank really has. So if the data continues to deteriorate in China, they can pull some of those triggers. But, you know, it seemed to be a bit of a point lost on the Fed last night somehow.
Now, I think the key thing about the Australian share market and how it's going to look to react, it really is almost a litmus test for global reaction, because it is the first market that will have a full trading day after that decision. What are we seeing so far? What are we likely to see? Is this just going to be a continuation of that roller coaster ride that we've seen in recent sessions?
Absolutely. And so far on this morning's action, that's exactly what we've seen. We came out of the blocks in a negative mood. I think we're down close to 1%, but we've reversed course amazingly. So there you go. The volatility still remains. So I think for the ASX 200, we're just going to be range bound between sort of 5,000 points as a floor, 5,200 as at a ceiling. And that needle is just going to be going every which way between those two numbers. All things being equal, of course, we're going to watch the US data. Of course, we're going to watch the Chinese data very, very closely. But volatility is here to stay until we get some finality, until we get some certainty in terms of where they're heading, when they're heading there, and then we can have a little bit of confidence, and maybe investors will come off the sideline. I'm talking the long-term investors. The day traders, the short-term traders are loving this volatility. This is the perfect market conditions for day trading. So they would be the ones that really are thanking Janet and co last night.
Much like then the local share market, the Aussie dollar is seeing some wild swings post-Fed. The US dollar has dropped to a 3-week low against a lot of the major currencies. How is this sort of playing out on those Aussie dollar, US dollar plays that we could see?
That was an interesting one last night, because the knee-jerk reaction, no change. Up went the Aussie dollar, then Janet Yellen's statement came out, down went the Aussie dollar. Again, volatility. So it's pretty much just on an even keel from where it started. It's picked itself up off the canvas a little bit. It was underneath 70 US cents. Of course, we had Malcolm Turnbull taking the Liberal leadership. That was a positive for the Aussie dollar. Overall, I think it's sort of going to be a bit of a case of sell the rallies, because we're not going to be hiking rates here anytime soon. The US, hopefully, definitely at some stage. So I think that means that the Aussie dollar is probably headed down, or the trajectory of the bias is certainly on the downside, I would anticipate. But it certainly was a volatile night for currencies right across the board last night. Glenn Stevens also made some comments earlier today, which actually helped the Aussie dollar. So it has been trending a little bit higher just in the last sort of little while of trading. So one to keep an eye on, and one that the traders are just going to target going forward.
Absolutely. Well, with that 4 a.m. announcement, I think it's fair to say we can all go home on this Friday and get a little bit of sleep. Ben, thank you so much for your comments today.
Pleasure. Thanks, Natalie.
A passionate Ben Brun there of OptionsXpress, urging the Federal Reserve to just go for it. That's all we've got time for right now. I'll be back with plenty more exclusive interviews for you. But for now, it's goodbye.